Bitcoin is not falling because of one single headline. It is a repricing of expectations, three forces at once: ETF outflows, higher real rates, and a rotation of speculative capital away from Bitcoin and into AI-linked stocks. Markets closed Friday, June 5, 2026. Here is where everything ended the week. Like and subscribe for daily market updates. Today's agenda: market snapshot, ETF flow pressure, macro backdrop, capital rotation, derivatives impact, Bitcoin deep dive, altcoin pressure, stablecoin role, is it time to buy, analyst forecasts, what to watch, closing summary. Now let's look at why these specific numbers are moving the way they are. Let's look at the numbers from Friday before the weekend. Bitcoin is trading around $60,100, having traded between roughly $59,100 and $63,600 over the last 24 hours. Ethereum is near $1,515, down close to 13%. Solana is around $60, XRP is near $1.06, and BNB is around $562. The total crypto market cap is about $2.06 trillion, down more than 5% on the day. Total 24-hour crypto volume is around $168 billion. That is important because falling prices with rising volume usually means real selling pressure, not just a quiet drift lower. Bitcoin dominance is roughly 58%, which means Bitcoin is still the anchor of the market, but not strong enough to protect the rest of the space from a broad decline move. Investor mood is poor. The crypto fear and greed index is in extreme fear, around 13, compared with 35 last week. That does not automatically mean a bottom is in. It means positioning, psychology, and forced selling are already stressed. For investors, seeing these numbers helps us understand that the market is under pressure from multiple directions, not just one bad news story. We must analyze these metrics carefully to avoid panic selling during a temporary correction. Next, we need to look at the big picture economic environment that is making this harder. There are four drivers behind the move, and the first one is ETF flows. US spot Bitcoin ETFs briefly ended a record 13-session outflow streak with a tiny inflow of about $3 million, after roughly $4.4 billion had left the product since mid-May. But the next available daily print showed renewed outflows of about $326 million. That is not a confirmed reversal. It is a fragile flow picture after heavy redemptions. ETFs make Bitcoin easier to buy, but also easier to sell. When traditional investors reduce risk, ETF outflows can become a mechanical source of pressure. This matters because institutional money is a huge part of the market. If they are pulling money out, it creates a direct drain on the price. Investors need to understand that a small inflow does not fix a massive outflow trend. The market needs several sessions of positive flows to rebuild confidence. Until that happens, the pressure remains on the price. This is why the flow picture is so critical right now. Institutional investors often have strict risk management protocols that force them to sell when unpredictable price swings spikes. Now let's see how other stocks are competing for the same investor money. The second driver is the big picture economic environment. The US jobs report showed 172,000 jobs added in May and unemployment holding at 4.3%. That gives the Federal Reserve less reason to cut rates, and markets are again talking about higher for longer policy. For crypto, that matters because Bitcoin and Ethereum are very sensitive to dollar available cash in the market, real yields, and risk appetite. When the economy is strong and jobs are plentiful, investors often feel less need to take big risks on speculative assets. Instead, they prefer safer investments. This is a challenge for crypto because it needs available cash in the market to rise. If the central bank is in favor of higher rates, that reduces the amount of cheap money available for investors to use. This makes it harder for risky assets like Bitcoin to perform well. The market is essentially saying that until we see signs of a slowdown or a shift in central bank policy, it will be tough for crypto to rally. Strong economic data often correlates with a stronger dollar, which is generally negative for crypto prices. Finally, we need to understand how borrowed money is making the decline worse. The third driver is capital rotation. Reuters reports that investors have been pulling money from Bitcoin ETFs, while semiconductor and AI-linked funds have attracted large inflows. This matters because crypto used to be one of the main expressions of speculative growth. Now it has competition from AI stocks, mega-cap tech, IPO expectations, and private market stories. Investors are looking for the best place to put their money. If they think AI companies will grow faster than Bitcoin, they will move their money there. This is a natural process in the market. Money flows to where it is expected to grow the most. Currently, the narrative around artificial intelligence is very strong. Companies are releasing new products, and earnings are beating expectations. This creates a powerful advantage for tech stocks over crypto. For crypto investors, this means they have to fight harder to get attention. It is not just about the technology of the blockchain, but about the story investors believe. If the story of AI is stronger, the money will follow that story. This rotation is happening regardless of crypto's intrinsic value. Now let's look at Bitcoin specifically and what it needs to do to recover. The fourth driver is derivatives. Recent data showed roughly $1.7 billion in crypto liquidations over 24 hours, with the majority on the long side. That tells us many traders were positioned for a rebound and were forced out when support broke. When prices drop, traders who borrowed money to buy assets are forced to sell those assets to pay back their loans. This selling pushes prices down even more. It is a vicious cycle. The more prices drop, the more people get forced to sell, which makes prices drop further. This is why the market can fall so fast. It is not just people deciding to sell, it is people being forced to sell. This creates a lot of panic. For investors, this means that a decline can happen very quickly if the market breaks a key level. It is important to know that this is not a choice, it is a mechanical process. Understanding this helps investors avoid getting caught in a bad position. Borrowed money amplifies losses during a crash. Next, we will see how other coins like Ethereum are doing even worse. Bitcoin is now testing the credibility of the long-term bull case. The positive on prices case is still clear. Limited supply, institutional access through ETFs, wider custody infrastructure, and a role as a non-sovereign asset in a world of fiscal stress. But the market is currently challenging two assumptions. The first assumption is that ETF demand is always a net positive. It is not. ETFs make Bitcoin easier to buy, but also easier to sell. When traditional investors reduce risk, ETF outflows can become a mechanical source of pressure. The second assumption is that Bitcoin always benefits from global political stress. In this episode, Bitcoin has not traded like a safe place to store wealth. It has traded more like a leveraged risk asset. Gold can rise when investors seek safety. Bitcoin often needs available cash in the market, falling yields, and risk appetite. At the moment, those conditions are not clearly in place. Technically, the 60,000 area matters because it is both psychological and close to levels where recent downside forecasts and derivatives positioning have clustered. A clean break below 60,000 could increase liquidation risk. A reclaim of the 63,000 to 65,000 zone would suggest the forced selling phase is cooling. Until then, Bitcoin is in a repair phase, not a confirmed recovery phase. Now let's talk about stablecoins and how they are changing the market structure. Ethereum is under more pressure than Bitcoin today. Ethereum is trading near $1,500, with a larger 24-hour decline than Bitcoin. That matters because Ethereum is supposed to benefit from ETF access, tokenization, stablecoin settlement, and decentralized finance activity. But in a risk-averse crypto tape, Ethereum often behaves like a higher beta version of Bitcoin. Solana is also down sharply, around $60. That is partly because high-throughput chains and ecosystem tokens depend heavily on risk appetite, retail activity, and on-chain speculation. XRP and BNB are also lower, but the broader story is the same. When Bitcoin loses its footing and available cash leaves the system, altcoins usually suffer more. For investors, the key distinction is quality versus momentum. Large, liquid networks may survive declines, but smaller tokens with weak revenue, low available cash in the market, or high unlock pressure can fall much further. In this environment, token selection matters more than the headline market cap number. Investors need to be careful about which coins they hold when the market is this weak. Now let's answer the question that everyone is asking: is it time to buy? One of the most important details is the role of stablecoins. CoinMarketCap shows stablecoin volume, representing the overwhelming majority of reported 24-hour crypto volume. Reuters also notes that stablecoins now account for a much larger share of the crypto ecosystem than a year ago. That tells us the market is not simply disappearing. It is becoming more dollarized and more cash-like. Investors are moving into stablecoins, waiting for clarity. This is defensive behavior inside crypto. It can later become buying power, but only if confidence returns. At the same time, regulation remains a structural driver. The US Senate Banking Committee advanced a crypto market structure bill in May, while UK lawmakers are pushing the Bank of England to soften planned stablecoin rules. The direction is clear. Crypto is moving deeper into regulated finance, but the transition is uneven and sometimes painful for risk assets. This means the market is maturing, but it is not yet a place for everyone to make easy money. Now let's see what other experts are saying about the future of the market. This is the practical question. The honest answer is that it depends on time horizon, risk tolerance, and whether the investor is buying a thesis or trying to catch a bounce. This is not personal financial advice. For long-term investors, extreme fear and large declines can create better entry points than euphoric rallies, but better price does not mean low risk. A disciplined investor would usually avoid going all-in after a single red candle. A more controlled approach would be phased buying, smaller position sizes, and clear rules for what invalidates the thesis. For short-term traders, the market is still dangerous. Unpredictable price swings are high, borrowed money has been flushed but not necessarily fully reset, and a break below key levels can trigger another wave of selling. The better question is not, is Bitcoin cheap? The better question is, has the market stopped punishing risk? To answer that, watch ETF flows, the dollar index, US yields, funding rates, open interest, and whether Bitcoin can hold above 60,000 without relying on forced short covering. Patience is the key here. Finally, let's look at the specific things we need to watch over the next few days. The forecast range is wide. Standard Chartered has warned that Bitcoin could fall toward $50,000 and Ether toward $1,400 before a recovery, while still keeping constructive longer-term targets. Reuters highlights a different concern. Capital that once chased Bitcoin is now chasing AI stocks, semiconductor funds, and upcoming megacap IPOs. Barron's and Investopedia describe the current move as a major confidence test after Bitcoin fell below 60,000 and crypto-linked stocks came under pressure. The common thread is not that every analyst is negative on prices forever. The common thread is that the market needs a new source of demand. That could come from ETF inflows returning, rate expectations easing, a weaker dollar, or a stabilization in broader risk assets. Investors need to watch these signals. If the demand does not return, the market could stay weak for a long time. It is important to have a plan for what happens if the market stays down. Do not assume a quick recovery will happen just because the price is low. Now let's wrap up with a summary of the main points from this briefing. Over the next 24 to 72 hours, the watch list is straightforward. First, Bitcoin's reaction around 60,000. Holding that area would reduce immediate liquidation risk. Losing it decisively would increase downside pressure. Second, ETF flows. One small inflow after a multi-billion-dollar outflow streak was not enough, especially with later daily data showing renewed outflows. The market needs several sessions of positive flows to rebuild confidence. Third, Ethereum around 1,400 to 1,500. If Ethereum continues to underperform, it suggests investors are not ready to rotate into higher beta crypto. Fourth, the US 10-year yield and the dollar index. Higher yields and a stronger dollar are usually a headwind for crypto. Fifth, liquidation and funding data. If funding normalizes and open interest falls, the market becomes healthier. If borrowed money rebuilds too quickly, another flush becomes possible. Investors should keep a close eye on these factors to manage their risk. Thank you for watching, and we will see you tomorrow. The crypto market is in a defensive phase. Bitcoin is near $60,000, Ethereum is near $1,500, investor mood is in extreme fear, and ETF flows remain unstable after a record outflow streak. The biggest risk is not one headline. It is the combination of higher yields, a stronger dollar, weak ETF demand, and capital rotation into AI. The biggest opportunity is that forced selling can create long-term entry points for investors with patience, risk control, and a clear thesis. But this is not yet a confirmed recovery. For now, the message is simple. Watch flows, watch 60,000, watch yields, and do not confuse unpredictable price swings with a confirmed bottom. Investors need to be ready for a long road ahead. Do not panic sell, but do not buy blindly either. Wait for the signs of a real change in the market. The crypto market is in a defensive phase. Bitcoin is near $60,000, Ethereum is near $1,500, investor mood is in extreme fear, and ETF flows remain unstable after a record outflow streak. The biggest risk is not one headline. It is the combination of higher yields, a stronger dollar, weak ETF demand, and capital rotation into AI. The biggest opportunity is that forced selling can create long-term entry points for investors with patience, risk control, and a clear thesis. But this is not yet a confirmed recovery. For now, the message is simple. Watch flows, watch 60,000, watch yields, and do not confuse unpredictable price swings with a confirmed bottom. Investors need to be ready for a long road ahead. Do not panic sell, but do not buy blindly either. Wait for the signs of a real change in the market. Thanks for watching Market Pulse Daily.